Hello and welcome to this weekend's market update. So this was a negative week, another negative week for the market. S&P 500, Nasdaq, Russell 2000, they were all down around 2.5%. Dow was down about 1%. And if you look at the weekly charts, they look, this is S&P 500. If you look at Russell 2000, just on a straight free fall. If you look at Dow, that's continuing to fall. Nasdaq is it's held up better than others, but I think it's beginning to see it's catching up with them. I get the feeling that based on the price action, I get the feeling that our markets are reacting not just on the fundamentals of the economy, interest rates, inflation, that sort of things, but I think geopolitical tensions are beginning to have impact on our markets. In 2022, when the first war started between Russia and Ukraine, there was a spike in oil prices, spike in commodity prices, wheat, corn, soybean, fertilizers, and that resulted in a huge spike in inflation for which the Federal Reserve had to increase interest rate to bring things under control. And when our markets were beginning to stabilize and move higher, now the second war has started in the Middle East. I have a feeling that war is beginning to have an impact on our market, and it's not yet clear how big the impact would be. But I get the feeling that a lot of investors and traders would be making decisions, because of their expectation on the war. If that's the case, then this selling can continue for a while, and it may take some time to repair the damage. Especially when I see that the weakness is spreading from smaller time frame to higher time frame. So let me explain what I mean by that. So let me just go to the daily time frame. When we had this decline in August, at that time the problem was primarily confined to the daily time frame. So if you looked at the daily time frame, you saw weakness, but the weekly and monthly, they were still fine. After that, we had a bit of a rally, and then we got a second round of selling. So when this happened, what happened is that the problem started spreading to the weekly time frame. So at that time, if you look at the weekly technical picture of Dow, Russell 2000, and S&P 500, you could clearly see those technicals were breaking down. And then we had a bit of a rally here, and now we're getting another round of selling. So what's happening is that this round of selling is now beginning to spread weakness to the monthly time frame, and we'll get to that very soon. Time frame. Now the point is, when you have a situation where you have weakness in all time frames, daily, weekly, monthly, that weakness can continue for an extended period of time, and it takes longer to repair. So I believe that this is basically what's been happening, because so far I've talked about the weekly technicals and how weak they've been. This is the S&P 500, but today I want to look at the monthly time frame and see what the monthlies are looking, especially when we have a month end coming up in a couple of days time. So this is the monthly chart of S&P 500. You can see that at the moment it is underneath this monthly 20 EMA, the blue line right here. The monthly EMA at the moment is at 41.76. Now S&P 500 closed at 41.17, so it's roughly 60 points below the monthly 20 EMA. If it doesn't reclaim the 41.76 by the end of the month, it will have closed underneath the monthly 20 EMA. Now, if you look at last year, you'll see that when it pulled back, it came to the monthly 20 EMA. This was the first candle, and it respected this level and bounced. The next month, it again came close to the monthly 20 EMA and it bounced. The following month, it closed at the monthly EMA. The month after that, even though it traded underneath the monthly 20 EMA, but it managed to hold the monthly 20 EMA. So you can see in 2022, it respected the monthly 20 EMA 4 months, right here, four months. But right now, this month, it's already below the monthly 20 EMA. So if it doesn't able to reclaim this, that tells me that there is quite a bit of selling intensity this time, because previously it respected this level, but if it doesn't do so this time in the first go, pretending that this line doesn't even exist, that's telling me that there's quite a bit of weakness. Now, in 2022, when the monthly 20 was lost, where did it go to? It went to the next level, which was the monthly 50 EMA, this pink line. So if it loses the monthly 20 this time, what's going to prevent it from falling to the monthly 50 EMA? This number. That number right now is around 38.50, this level right here. So if it doesn't respect this one, then what's going to stop it from going to this level? Because we saw that happening in 2022, and during COVID we saw that. Even before that, we saw it touch the monthly 50. We saw the monthly 50 touch right here. So you can see that it has a history of touching the monthly 50, which currently has 38.50. So what's going to stop it from going to that level, right? So, but the point I'm making is that I'm beginning to see weakness on the monthly time frame. Now, if you look at RSI is right at 50 level. This is a very, very important level. You can see it was a support right here. Now, if you look at the weekly time frame, I'll show you something. On a weekly time frame, if you look at RSI was very important. It fell and then it tried to reclaim, but then got rejected. When it got rejected, we see a big decline in the weekly level. Just like back in 2022, when there was a rejection, and then after the rejection, we saw a decline right here. Now, similarly, on a monthly time frame, if RSI 50 level is breached, I would expect market to fall quite a bit. So this is a very important level. If you look at back in 2007, 2008, it fell below 20 and then it tried to reclaim. Once it got rejected, that's when we saw a big decline. Now, I'm not saying that something like that is going to happen, but what I'm saying is that the price action is currently on the monthly 20. RSI is at a very important level. You see MACD is beginning to cross. If it crosses and starts to move lower, that would show me weakness on monthly time frame also. So weakness on the daily, weakness on the weekly, weakness on the monthly means that it's going to take some time. In 2022, you can see that once monthly 20 was lost, it spent months between the monthly 20 and 50 before making a recovery. So the point I'm making is that I'm starting to see weakness on the monthly, so I think we should be careful. Now, it's no point talking about levels, because when markets react to external factors, then levels are it's not relevant. You can draw any number of levels and the market's not going to hold, but I wouldn't be surprised to see 38.50. Yeah, 4,000 is a psychological level, but monthly 50 is around 38.50. So my attention is drawn to that level because I know that previously when the monthly 20 went, it went and touched. It doesn't mean that it's going to do it this time, but I am at least aware where that level is. If you look at the other indices, Russell 2000, clearly, this is a monthly chart. You can draw two lines like this way. It's about to break out of this range to the downside. That would be a massive breakdown in Russell 2000. You can see RSI has clearly broken the 50 level. MACD is getting rejected at the 0 line, so that's looking weak. If you look at Dow next up, you can see that Dow, over the last several months, the monthly 20 has provided support. Now it's underneath the monthly 20. The monthly 50 is around 31,230. This pink line is 31,000. Dow closed at 32,417. So that means this level is around 1,200 points below. If you look at NASDAQ 100 is still above the monthly 20. The monthly 20 is around 13,660. This level is 13,660. So if it wants to come and touch it. Now, the reason why NASDAQ 100 is still above the 20 EMA is because of stocks like Microsoft and Apple, the two biggest companies. They're kind of holding up NASDAQ. But if you look at NASDAQ composite, that composite is already under the 20 EMA. So that is definitely showing the weakness, and RSI is right at the 50 level. So clearly all of the major averages are now either beginning to show or at a very, very important juncture from a monthly point of view. Now, if you look at the sectors also, if you look at, for example, XLK. Now, XLK is still holding up okay. As I said, the two biggest contributors are Apple and Microsoft. They're kind of holding it up. But if you look at the second heaviest, this is healthcare, beginning to break down. This is like a big distribution. It's already below the monthly 20, monthly 50 is at this level. If it breaks below this level, this would be the first time it's closing underneath the monthly 20. You'd have to go back to the 2007 2008 time frame. And if you look at RSI is now breaking below this important RSI 50 level support. Last time it happened was during the financial crisis. So this is looking quite weak to me. And look at MACD. This is just going down. Don't know that at this speed it holds the zero line, but that's looking weak to me. If you look at next up financial, this is the third heaviest. That's also looking weak. Monthly lower highs. If it closes underneath this level, that's like a breakdown in support level. If you look at discretionary, Tesla and Amazon are the biggest members right here. It's beginning to close below the monthly 20 and 50. RSI is underneath monthly 50. Industrials, again, weakness, breaking below this previous low right here. RSI is below the monthly 50. Staples, usually this is a defensive sectors. When there's turmoil, investors move to the safety of the defensive sectors, but you can clearly see that it's beginning to break down from a monthly you can draw this to be a monthly channel and then a break of this channel. So that's not looking good to me. Look at MACD. RSI is below. Look at MACD, the way it's falling. Energy, putting in a big red candle this month. This is an important level. While price has gone up, and look at RSI, it's been going the other way. As price has moved up, MACD has been telling us that this is not sustainable. So be aware, be careful with energy. Building materials, looking toppy to me. If it breaks this level, momentum indicators are already weak. Let's see what else. So if we look at real estate, that's just a total breakdown. Utilities, again, complete breakdown of this uptrend. Transportation, again, that also is breaking down. If I look at some of the individual names, the big, Tesla on a monthly basis, not looking very good. It's already underneath the monthly 20 EMA. So that's not looking good. The 50 EMA is around 195, this pink line. If it goes up at 195, that's negative. RSI is already below, has moved below the 50 level. So that's looking weak to me. Apple is holding up so far. It's approaching the monthly 20 EMA, which is around 163. See, Apple held up much better. Oh, sorry, slight technical problem. As I was saying, Apple is approaching its monthly 20 EMA, which is around 163. Last time in 2022, Apple actually held up better than other stocks, and at that time it didn't touch the monthly 20. The question is whether it wants to do that this time. You can see that it does have a history of touching the monthly 50. So I'm not saying that that will be the case, but if all the other averages do so, then I wouldn't be surprised. But at least for the time being, I'm watching how it deals with the monthly 20 EMA, which is around 163. Microsoft, it's held up very well. Last year it did touch the monthly 20, so it's still above the monthly 20. So this is one of the stronger looking chart. So I'm not seeing any weakness on the monthly time frame at this point. Nvidia, you can see that after touching the monthly 50 last year, massive rebound. There's still quite a bit of gap between the current price and where the monthly 20 is. Forget about monthly 50, monthly 20 is. Monthly 20 is around 305 and the stock is at 405. So there's a 100-point difference between the current stock price and the monthly 20. Meta is well above the monthly 20, but if you look at the current month's, so this is potentially a negative looking pattern. So we'll see what happens, but it's still well above it's still a strong looking chart. The monthly 20 is around 242. So there's still a decent gap between the current price and the monthly 20. Amazon is at the monthly 20 and 50. RSI is at the 50 level. So Amazon is at a very important level. Google, bad week this week. For the month it's down 6.5%. So the monthly 20 EMA is around 116. AMD is right at the monthly 20. Netflix is at the monthly 20 and 50. RSI is at 50, so at an important level. Super Mario Computer, there's still a big gap between the monthly 20 and 50. The monthly 20 is, 157. Lilly, another big high-flying stock. Big gap between the current price and the monthly 20, which is around 400. Monthly 20 is at 400. Current stock price is 560. So there is a 160 point spread between the current price and the monthly 20 EMA. So I've shown you that major averages are beginning to kind of show some weakness on the monthly time frame. The question is there anything that might benefit from all of this? One possibility, this is just a hypothesis, one possibility is maybe the bonds. If there is tension, geopolitical tension, maybe investors want to move to the safety of bonds. And this is US treasuries that come in. I mean, with yields around 5%, and with stocks falling, I mean, why wouldn't bonds be attractive? Especially because they've run up. And maybe the geopolitical issues start to slow down the US economy, and maybe it pushes it towards a recession. And if so, bond prices may go up and yields may fall. So this is one area, I'm thinking. The other thing is that Federal Reserve has a meeting next Wednesday, 1st of November. And I think the Fed officials have communicated to the market that they don't want to, there's a good chance that they may not increase interest rate any further. So if Fed funds rate don't move up from the current level, which is 5.5%, so I'm not sure that the yields in the market are going to go up significantly higher from current level. So if the Fed funds rate is at 5.5%, right? Let's say this is where, I mean, the 2-year, the 10-year, the 30-year, they would have to be a little bit underneath that. Why? Because they reflect a bit of a recession premium, and that's why they're going to be slightly under the Fed funds rate. I mean, I wouldn't expect Fed fund rate to be here and 10-year, 2 years to be up here. Because what the yields are telling me, the 2-year is saying is that where the yields are expected to be in 2 years' time. So if you believe that there's going to be a recession within the next 2 years, then there's no way 2 years should be above the Fed funds rate. 10 years should be above the Fed funds rate. I mean, the 10 year, which is around 5%, is telling us where yields would be in 10 years' time. And if you think that there might be a recession within the next 10 years, then surely the 10 year cannot be above 5.5%. So I think the bond yields, are close to a top as long as Fed funds remain stable around 5.5%. Now, that doesn't mean that the bond yields are going to fall. They will fall if there is weakness in the market. That would be the only reason. Otherwise, they can remain up there. But if there is a geopolitical tension, that could start to have an impact on the economy as people become a little bit cautious about spending, and companies are also cautious about capital expenditure, and so forth and so on. So I could see one of the beneficiaries to be bonds, not because they are considered safe. They could be flight to quality reason. People could be moving to bonds from stocks, and that pushes up bond prices. But I also could see the geopolitical tension, the war in the Ukraine, Russia, and the Middle East start to have an impact on the economy and slows down the economy to the point bond prices rise, bond yields pull back on the expectation that there would be a recession, and maybe Federal Reserve starts to cut interest rates sometimes in 2024. Well, so that's the commentary for this week. I'm going to be watching the market next week and come back with another update. In the meantime, I thank you very much for watching the video. Thank you.